There's a truck in the parking lot of every office building in America. You've seen it. Full size, new enough that the paint still has that specific depth that used to cost significantly more than it does now that everyone has one. Crew cab, lifted slightly, wheels that didn't come standard, a payment sticker somewhere in the $800 to $1,100 range on a loan term that will outlast most of the relationships the driver started while making it. And the person who drives it works at a desk, not hauling equipment, not towing a trailer, and not using the bed for anything except occasionally transporting a piece of furniture from a store that would have delivered it for $79. The truck is transportation, expensive, fuel-consuming, difficult-to-park transportation that costs more per month than some people's rent and depreciates at a rate that would make a financial planner visibly uncomfortable if you described it out loud. Here's the question nobody in that parking lot is asking. Who can actually afford this? Not who qualifies for the loan. The bar for loan qualification and the bar for genuine financial affordability are two different bars set at two different heights by two different parties with two different interests in the outcome. The lender wants the loan serviced. Your financial life wants the truck to be a foundation rather than a ceiling. Those are not the same objective, and they don't produce the same answer. My name's William. Today we're going through the real math, what a $50,000 truck actually costs across every dimension of ownership, what income and financial profile genuinely supports that cost without structural damage, and what the honest answer looks like when someone who isn't trying to sell you a truck runs the numbers.
First, what a $50,000 truck actually costs, not the payment, the cost. The average transaction price for a new full-size pickup truck in America in 2026 is approximately $58,000. The $50,000 truck is not the expensive version. It is approaching average. The Chevy Silverado, Ram 1500, and Ford F-150, the three best-selling vehicles in America for decades running, all have configurations that cross $50,000 before the option sheet gets aggressive. Let's use $50,000 as the purchase price. 10% down, $5,000. Loan amount, $45,000. Current average new truck loan rate, 6.8% for strong credit. Term, 72 months, the average new vehicle loan term in 2026. Monthly principal and interest payment, approximately $769. That is one number. Here are the others. Full coverage insurance on a new $50,000 truck in a mid-range American market, approximately $220 to $320 per month, depending on your profile, the specific vehicle, and your zip code. Trucks carry higher insurance premiums than equivalent value cars because of repair costs, theft rates, and claims history. Call it $270 per month, $3,240 annually. Fuel. A full-size V8 pickup truck averages approximately 17 miles per gallon combined. At the national fuel price of approximately $3.50 per gallon and 15,000 miles annually, annual fuel cost approximately $3,088, monthly $257. Maintenance. First 3 years under powertrain warranty, minimal beyond oil changes and tires. Tires on a full-size truck, $800 to $1,400 for a set, needed every 40,000 to 60,000 miles. Call it $150 per month, averaged across the loan term. Total monthly cost of truck ownership, $769 payment, plus $270 insurance, plus $257 fuel, plus $150 maintenance equals approximately $1,446 per month. Not $769, $1,446. The dealership showed you $769. The bank approved you for $769. Your life costs $1,446 per month for this vehicle, and neither of those parties had any financial incentive to show you the complete number.
The depreciation, the cost that doesn't show up monthly but never stops running. Full-size pickup trucks depreciate at approximately 15 to 20% in year one and approximately 40 to 50% over 5 years. The $50,000 truck purchased today is worth approximately $40,000 to $42,000 at the 12-month mark and approximately $25,000 to $28,000 at the 5-year mark. At year 3, the point most people consider trading in or upgrading, the truck is worth approximately $30,000 to $33,000. Your loan balance at that point on a 72-month loan at 6.8% is approximately $29,000 to $31,000. You are at or near break-even on equity, which sounds acceptable until you realize that the $5,000 down payment you made at purchase has been entirely consumed by depreciation, and you have 3 more years of payments remaining on an asset that will continue declining in value for every month of those 3 years. This is the structure most truck buyers accept without calculating it, not because they're careless, but because the monthly payment frame that dominates the purchase decision makes the total depreciation cost invisible until the trade-in offer arrives and the number is lower than expected, and the finance manager is ready with a solution that involves rolling the negative equity into the next loan. 29% of all vehicle trade-ins in 2026 are underwater. Among truck owners who financed in 2022 and 2023 at elevated prices, the underwater rate is higher. The depreciation was always in the math, it just wasn't in the presentation.
The income question, what you actually need to earn. The standard affordability guideline, total transportation costs below 15% to 20% of gross monthly income, produces the following income requirements for this truck. At $1,446 per month in total ownership cost, the 15% gross income rule requires monthly gross income of approximately $9,640. Annual gross income of approximately $115,700. At the 20% rule, which is the outer edge of transportation affordability, not the target, monthly gross income of $7,230 is required, annual gross income of approximately $86,800. The median household income in America in 2026 is approximately $83,700. At the median income, this truck consumes approximately 20.7% of gross income, slightly above the outer limit of responsible transportation spending, before taxes, before housing, before food, before every other financial obligation the household carries. At median income, the $50,000 truck is not technically unaffordable. It is structurally irresponsible, consuming a portion of gross income that leaves insufficient margin for the savings rate, the retirement contribution, the emergency fund, and the housing cost that responsible financial planning requires simultaneously. The income profile that genuinely supports this truck not just services the loan, but maintains it without structural damage to the rest of the financial life is a household earning $120,000 or above with low existing debt, a funded emergency fund, active retirement contributions at or above 15% of gross income, and total fixed monthly obligations below 50% of take-home after adding the truck payment. That profile describes a specific and relatively narrow slice of the people currently making payments on $50,000 trucks in office parking lots across America.
The net worth test, the millionaire standard. The Ramsey Solutions study of over 10,000 millionaires, people with net worth exceeding $1 million, found that the median vehicle purchase price among millionaires was $31,000. 61% drove Hondas, Toyotas, or Fords. The average millionaire spends approximately 1% of their net worth on a vehicle. At 1% of net worth, affording a $50,000 truck requires a net worth of $5 million. At 5% of net worth, which is on the aggressive end of responsible vehicle-to-wealth ratios, the truck requires $1 million in net worth. The median American household net worth at age 45, the peak truck-buying demographic, is approximately $168,000. At 1% of net worth, that household can responsibly afford a $1,680 vehicle. At 5%, an $8,400 vehicle.
The $50,000 truck represents 30% of the median 45-year-old household's net worth, not 1%, not 5%, 30%, applied to the vehicle that spends its days transporting a single occupant to a desk job. This is not an argument that nobody should buy an expensive truck. It is an argument that the financial profile required to do so without structural damage is considerably rarer than the parking lot suggests. Who actually can afford it? The honest profile. Household gross income above $130,000 annually, preferably $150,000 or above for genuine comfort rather than technical viability. Existing debt payments below $500 per month combined. Student loans, credit cards, personal loans. If these exist at meaningful balances, they compete with the truck payment for the same margin, and the combination produces a fixed cost structure that eliminates financial flexibility. Net worth above $300,000 with liquid assets, accessible savings and investments outside retirement accounts of at least $50,000 to $75,000. Liquid assets matter here specifically because the truck is illiquid. It cannot fund an emergency. It cannot be partially sold. It cannot serve any purpose other than transportation and depreciation. The liquid assets need to exist independently of it. Emergency fund fully funded at 3 to 6 months of expenses before the truck payment is added to the fixed cost structure. Adding a $1,446 monthly transportation obligation to a household without an emergency fund is adding structural vulnerability at the exact moment the monthly margin is contracting. Retirement contributions at or above 15% of gross income, maintained through the purchase, not paused to make the payment fit, not reduced to make the monthly budget work, maintained at the rate required to reach retirement readiness on schedule, regardless of the truck being in the driveway. One more condition worth naming. If you need the truck, if your work genuinely requires hauling, towing, or the capability that a full-size pickup provides in ways that a less expensive vehicle cannot, the financial case changes. A tool that earns money or enables income has a different cost-benefit calculation than a vehicle whose primary function is commuting. The contractor who needs a truck for work is making a business capital decision. The marketing manager who wants a truck because it feels like the right vehicle for the version of themselves they'd like to project is making a status purchase with truck pricing attached. The financial profile required to afford the status version without damage is the one described above. The professional version, where the truck earns its cost, requires a different calculation specific to the work it enables. What the parking lot is actually full of. The median American household at median income buying a median-priced truck at current rates and terms is spending 20% or more of gross income on transportation before any other vehicle in the household, before any other transportation cost, before the gas and insurance and maintenance that complete the actual number. They qualified for the loan. The bank confirmed it. The dealership processed it. The payment fit inside the approval criteria that the lending industry uses to define affordability. And the financial margin available for retirement savings, emergency funds, debt elimination, and every other financial priority is reduced by $1,446 every month for 72 months, 6 years, on an asset worth approximately $25,000 by the time the last payment clears. That is not affordability. That is loan qualification wearing the costume of financial solvency. The truck in the parking lot isn't evidence that the driver can afford it. It's evidence that the lender calculated they could service the payment. Those are two different things, and the parking lot has never been very good at telling them apart. The lender approved you for the payment. Your financial life requires something more demanding than that. Run the full number before you run the plates. Subscribe for a new video every week and drop in the comments what you currently drive and whether the math works. No judgment, just honesty.